The value of the firm is the present value of its operating cash flows. Therefore, the financial manager has only two options for maximizing firm value: either increase the operating cash flows or decrease the discount rate. In this video introducing the cost of capital, we focus on that discount rate and how it is calculated. As you are about to see, the appropriate discount rate for the firm's operating cash flows is its weighted average cost of capital. From the fundamental corporate finance identity, we know that the market value of the firm equals the market values of its equity plus its debt. Equivalently, we say that the assets of the firm are financed by its capital, being its issued shares and bonds. For completeness, we divide equity into ordinary and preference shares. Therefore, capital has three potential components, and the cost of each one is called its component cost of capital. The component costs are combined into an overall weighted average cost of capital for the firm. This creates an easily understood structure for the study of the cost of capital. On the left-hand side, we have WACC, which is used to discount the cash flows produced by the firm's assets and is a combination of the costs of the firm's different capital components. This means that we need to establish a systematic basis for calculating that overall combination number. It seems intuitively right that this would be done on the basis of some kind of average of the component costs, and this is in fact the way it is actually done using the firm's target capital structure. Looking now in slightly more detail at each of the component costs, we start with the cost of ordinary equity. There are a number of methods for determining this. The most commonly applied approach is the well-known capital asset pricing model, or CAPM. This specifies the cost of equity as a risk-free rate plus a risk premium, which is calculated using a factor called beta, as well as the expected return on the market as a whole. Another method is to rearrange the Gordon growth model for the valuation of a share so as to have the discount rate on the left-hand side. Thirdly, cost of equity can also be estimated using the firm's own cost of debt as a reference point. Finally, there are so-called multi-factor models. Preference shares come in many different varieties. Here we consider only the simplest form, which is a perpetual instrument paying a fixed dividend. In the same way that the Gordon equation can be used to calculate the implied cost of equity, the equation for valuing a perpetuity can be rearranged to back out the cost of a plain vanilla preference share. The cost of debt is determined using basic time value of money principles, given an understanding of the typical cash flow patterns of bonds. These are financial instruments which pay the investor a stream of repetitive interest cash flows called coupons, and at maturity date repay the face value. The cost of debt is typically calculated by entering these details into a financial calculator, a spreadsheet, or an app and solving for the interest rate, which is called the bond's yield to maturity. The yield to maturity method can be used only when the bond's market value is known, which means that it has to be traded in an active market. If this is not the case, there are alternative methods for estimating the cost of debt. Finally, we deal with tax effects. It is generally the case worldwide that the cost of debt is deductible for tax purposes, while the cost of equity is not. Therefore, the cost of debt reduces the tax bill of the firm, while the costs of ordinary or preference shares have no such benefit. This means that the equation for WACC contains a term recognizing the tax benefit of the cost of debt. This is called the tax shield of debt. Notice that it does not appear against either of the equity costs.